You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is time once again for TWIFO, This Week in Futures Options, a program where the name says it all. We break down the week that was and indeed still is from a futures options perspective. So we'll go out and explore some of these other hot markets, see what's going on, maybe in ags or rates or metals or equities. You never know who's going to make it on the show. Crypto, energy, you got to tune in every week to find out. My name is Mark Longo from theoptionsinsider.com, as well as, of course, on the ever-exciting network. You guys know where to go to join us live and get all the other exclusive shows and everything else we do. Theoptionsinsider.com/pro, or if you're really cool, theoptioninsider.com/secret club. Unfortunately, this is our final show for the week here. Don't blame me. Blame the holiday tomorrow, cutting everything off. But we'll be back again next week with our usual assortment of fun out there for you folks over there. And of course, however you listen live after the fact, hit us up. Questions, comments, insights, pearls of wisdom. We do love to hear from all of you guys and gals out there. And let's see who we're hearing from on the show today. There we go. Uncle Mike TOSAW from St. Charles Wealth Management. Uncle Mike, are you there, sir?
I am here.
All right, perfect. I know the Skype gods have not been smiling upon you of late, but I'm glad to see that you are able to join us here for the penultimate TWIFO of 2021. A mad year indeed, sir. But you know what time it is now, Mr. Uncle Mike. It is time for the movers and shakers.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right. Mr. Uncle Mike, you know what I'm going to ask you now. This is, of course, the Movers and Shakers Report, listeners, where we break down everything moving to the light side, a.k.a. the upside, and to the dark side over there at CME Group this week. So, Mr. Uncle Mike, if you are prepared, if you are ready, where should we begin our journey this week? To the light side or to the dark side, sir?
You know what? It's the last episode of the year. Let's go to the light side.
Second to last, the penultimate. Next week will be the last, but second to last is still an important position. I'm glad you could make it on for us. All right, light side. I had a feeling you'd want to go light side this week. And our light side seems to be dominated by a product category this week. You can probably pick it out in a few seconds here, listeners. Number 5 is lean hogs, up 3.92%. It was number 1 in the same direction last week, up almost 10.5%. Number 4, our old friend, the Russell 2000, back to the light side this week, up 3.92%. So maybe a little bit of the old Santa Claus rally back in effect after Russell 2000 moving to almost effectively correction status. Interesting times in all things small caps. It was number 10 in the other direction last week, so not even in our bottom five, only off about 0.5% or so. Number 3, good old Chicago wheat, up 5.65%. Number 2, KC wheat, up 6.5%. And number 1, hanging out in the ag still, soybean meal, up 8.89%. So a robust week for the ags, to put it mildly. Let's go to the dark side now. Number 5, we've got oats, off 1.37%. It was number 3 in the same direction last week, off 1.63%. Number 4, it's the Nikkei. The Nikkei denominated in the yen, off 1.88%. And before you ask, oats and Nikkei, not exactly big options players out there. Then number 3, we got a product that can do some paper. It's the 30-year, off 1.91%. Numero due, we got the old euro dollars there, off 4.65%. It was number 1 in the same direction last week, off a similar percentage. And number 1 with a dark side bullet this week is lumber, off a comparatively quiet 6.26%. This thing can move 20% in a week sometimes, if not more. It was number 2 in the other direction last week, up 9.21%. So still more volatility for lumber going into the end of the year. Who'd have thought one of the hottest products of the year would be dead trees? But that's where we stand. Now, Uncle Mike, this is usually the portion of the show where I ask our guest where we like to go first. But because we have the 30-year here in our dark side, and because I know you love yourself a little bit of getting on the boat with the 10-year note, and because our chat's already getting ahead of me, we got Age of Delaquarius in there saying, my first live TWIFO. Well, first off, welcome. Then he says, I hope you discuss interest rates on this show. Well, that's a trifecta. How can I fight against that? So let's start off in the world of rates.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody. Welcome to the world of rates. You guys know where to go to follow along with the journey. You could do it if you're listening live. You could do it after the fact. Whenever you're listening to this fine program, these reports are always live. You can always check them. You can check them at 2 a.m. on Saturday if you are so inclined. Whatever floats your boat, head on over to cmegroup.com/TWIFO, TWIFO. That's the best way to go. You can also go /TWIO. Some web designer thought the name of the show was This Week in Options for some reason. He forgot to add the futures. So both of those will work, TWIO, TWIFO. Both of those will get you to our reports. Once you're there, listeners, go to that drop down there for the asset class and scroll almost all the way down to the bottom to interest rates. Then we're going to go to U.S. rates. And then from there, you'll see a whole bunch of product categories, including the 30-year and Uncle Mike's favorite product, the 10 years. Mr. Uncle Mike, let's start there. You've been talking for a while now in some of our other programs, the option block, about how you haven't maybe been seeing the move in the 10-year that you would thought that would be commensurate with the sell-offs and some of the moves we've seen in the broad equities. So let's start there. First off, explain to our audience, why are you so fascinated these days by the 10-year note? And then B, what are you seeing out there of late, sir?
Well, I think that we haven't seen the rally in it from the sell-off, because the sell-off actually didn't happen in the stock market. So we had a little bit of inverse movement, which we'll have at times. But overall, the market came back. Everything is awesome again in the stock market. So with the 10-year note, it is more of a channeling product. Stocks are more of a trending product, but with the 10-year note, I think I saw something on social media recently showing the S&P prices over the course of the last 10 years, and then the yield in the 10-year note over the last 10 years, and then the difference in the yield has had a movement. And of course, it had more at certain times because it's kind of cherry picked some times, but the range was roughly 20 basis points, whereas, of course, the S&P has had a tremendous movement to the upside. But in terms of what I'm looking at, I think the 10-year note's going to tell us a lot of things over the course of the next 12 months or so, just because of the fact that we have 3 rate hikes in theory factored in with the Fed. I believe last I looked at the Fed funds futures, I think we had 70 basis points as the likely raise for the Fed over the course of the next year. I'm not sure. I don't follow it too closely, but that was when we were discussing it yesterday with someone else. And so ultimately in the stock world, the S&P E-mini is like the king of all what moves and what makes the world turn, so to speak. And in the bond world, it's a 10-year note. So that's why I am very fascinated by it and why I look at it, because of the fact that if we were to have a major sell-off in the stock market, typically a lot of times we have a lot of buying in the bond market because we have to have that money go somewhere, and oftentimes it is a rush to safety, if you will. Now, what's happening with the 10-year note right now, I think it's pretty interesting, is if you look back to August, we still haven't had the highs of it that we've had since late August. But we have had several bottoms, and I'm just looking at the March contract right now. We bottomed out with a low about a month ago on November 24th. We're at 128, low to 128s. And then now we've rallied. The high since then was 3 days ago when we were over the 131 level, and now we're back at the low 130s with it. So on this, you could argue and say that maybe this is just a little bit of a pullback from the rally in the 10-year note. But what I'm thinking is happening right now is that it's just staying within the range with which we've been in. We've been pretty range bound in the 10-year note, I would say, ever since early October. And we're towards the top of it. We were at the very top of it, or we did kind of break through it 3 days ago. But we've come down a little bit, but we're still near the upper end of it as we're going. Now, it didn't seem to make a major move when the Fed said that they don't want to use, I'm trying to think of the word, transitory inflation anymore. They don't want to use the word transitory anymore. So the 10-year note did not have any major drop-off or any major rally on it. So apparently when the stock market rallied off of transitory, it really wasn't, it seemed to maybe relieve the stock market for a little bit. Oh, thank God, transitory is no longer in existence. And then it sold off the next day in the stocks. 10-year notes just kind of stayed fairly range bound. So I like where it's at right now from the standpoint that it's range bound. And what I've been doing a lot of lately for the fixed income section of what I've been doing with my clients is I've been selling premium, been selling covered calls, short puts, and I think it's been great as an alternative to just simply investing in bonds from a portfolio standpoint. Right now, as anyone that hasn't been under a rock for the last 15 years knows, is that yields are not very high right now. And in the 10-year note, we're sitting at roughly 1.4 and some change. And so in the 10-year note, where the yields are you're not going to get rich investing at 1.4% annually over a 10-year period. But what you can do is you can sell covered calls while owning it, or you can sell short puts. You can create your own yield and you can make it significantly higher. And that's what's really exciting me about the 10-year note at this stage, is that if you go anywhere to any financial publication, the hunt for yield. And so oftentimes where people are looking for more yield is that they're tending to go more towards preferred stocks or higher yield bonds, aka junk bonds. But I think it's more prudent, and I'm not saying you shouldn't do those things I just mentioned, but I think another significant section of your bond allocation should be in short premium government treasuries. And I think it's a great time to be doing that by comparison to just simply owning bonds.
Let's see what's lighting it up today in Uncle Mike's favorite product, which is the 10-year note, and actually doing some paper this week. You know, the mid to longer portions of the yield curve may seem sleepy, but they do a lot of paper over there at CME. Right now, the 10-year closing in on 1.5 million contracts out there. And of that, nearly 31% in the contract that's going out today. So not going to hang our hat too much out there, listeners. Let's go a little bit farther out, see if we can get a little bit more sane paper. The next most active contract is the Feb contract going out in about 29 days. So you got a little bit more meat on that bone. Coming into today's show, the 10-year at about 130.17 out here. In terms of vol, now we're not really playing on the mid to farther portions of the yield curve and looking for a lot of volatility. If you are, you're doing it wrong, because that contract in Feb right now coming in at a whopping 4.76. Yes, not even a 5 handle on the vol. That said, it is up about 0.2 of a point this week, so a little bit more juice out there. In terms of skew, again, you're not talking a lot of vol, you're not talking a lot of skew out here. Last week, the puts were 1.4% bid, and the calls were 0.1% cheap. So the calls were effectively flat. There was no call skew. This week, the puts are a little bit more bid, nearly 4% bid, and the calls are a little bit cheaper, 3.1% cheap. So we have seen a little bit of an evolution in the skew. It's a mini equity skew, if you will. Not a huge evolution, but some out there. And in terms of action, let's see. There is a lot of paper going up out here. It is actually the 130.5 put going out in about 1/10 of a session. So later today, that has the number one spot out here in the 10-year with 77,000 of these bad boys going up this week. The big day, kind of a tie, actually, between Tuesday and today, both doing about 25,700 contracts. Most of that closing on Tuesday. We don't know what's up with today's paper, obviously. Wednesday, about 21,000, only about 5,000 on Monday. Still a pretty active contract all the way around. Then we get to number 2. We actually have to go out a little bit for number 2. We have to go out to March of next year, the 128 half put, doing 62,400 contracts, pretty much active all week. 20,500 on Monday, 24,500 on Tuesday, about 12,500 on Wednesday, and about 5,000 today. Opening all week long on these March 128 half puts. So intriguing, looking at a little bit of downside there in the 10-year. Looking around, let's look at some other real quick spots, see if we see any other interesting nuggets out here. Those seem to be some of the biggest trades. Mr. Uncle Mike, we also have lighting it up on our movers and shakers this week, the 30-year. Do you ever get that far down the yield curve, sir?
I typically don't. I think the 30-year is a little bit too volatile for my taste. And then the 2-year is a little bit too boring for my taste. 10-year is kind of the sweet spot for me. 30-year is something to where I think it's more of a tradable product, if that's what you're looking at. But on the investment side, where I live, so to speak, 30-year just moves a little bit too much for my taste.
It is funny. When you say that, it's kind of counterintuitive, right? That going farther out equates to a little bit more volatility. But you're right. I'm looking at the numbers right now. Again, you can go to that drop down, listeners, back out of the 10-year and go a little bit farther down to the 30-year. You'll see to yourself, the vol's roughly double what it was out there. In the 10-year, we were talking around a 4, right, listeners? And you're talking about an 8.5 to a 9 out here in the 30-year. So intriguing stuff. Once again, all the paper, 51.5% of the 420,000 contracts going up in the contract that's going away later today. So not going to hang our hat there. Instead, let's go a little bit farther out. Let's go out to February here as well, where about 25% of the paper went up this week. We're at about a 160.18 out here on the 30-year. And again, vol-wise, pretty much double what we were just talking about. A little over 9, up about 0.15 this week as compared to about a 4 3/4 for the 10-year. Skew-wise, a whole lot of nothing, really. 1.4% rich last week were the puts. 1% rich were the calls, so a little bit of a bid to the wings this week. That's pretty much gone. The puts are flat, and the calls are about 0.7% bid. So not a lot of skew to really speak of out there. And if you want the action, 30,000 of the 161 puts that was leading the dance out there in the 30-year this week. The most active day was actually Tuesday, with about 14,000 going up there, followed by nearly 10,000 on Wednesday, 4,000 today, and about 2,700 on Monday. And again, looks like a lot of that paper Tuesday and Wednesday, the more active days, were closing. So some closing on the 161 put strike here, which, like I said, is pretty much an in-the-money put at this point here, followed by number 2, the 161 call. So that 161 strike going out today, where pretty much all of the action was, 28, almost 29,000 of those going up today. Again, the big days, Tuesday and Wednesday, not exactly surprising. Whenever the Fed's hanging out, you're going to see some action in the rates. 12,000 on Tuesday, 10,000 on Wednesday, both of those days pretty much closing. Still 6,000 today, so decently active today. Total of nearly 29,000 on the week. And then we got the 160 half puts for number 3 at 22,700. So pretty active. Those ones actually a little bit more spread out, kind of a tie between today and Tuesday with about 76, 7,700 each on those days. So intriguing stuff here on the 30-year. Again, it is a little counterintuitive, maybe listeners, that you go farther out, you get more vol, but that's exactly what we're seeing. The 10-year Uncle Mike's sweet spot. Is that your sweet spot? Do you sling a lot of rates? If so, how do you do it? Maybe you more of a TLT person. You can actually come in here to the futures and the futures options. What's your preferred vector for the rates? Speaking of preferred vectors, since he's joining us on the show today, and even though they're not in our movers and shakers, let's do a real quick hangout in the metals.
Werewolves beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
Mr. Uncle Mike, when you're not hanging out in the boat with the 10-year note, I know you're looking at a little bit of silver, maybe a little bit of gold out there as well. What, if anything, is lighting up your tape in the world of the shiny stuff these days, sir?
Well, I mean, silver has just been kind of hanging out where it's at right now. And I think that with where we're going, it's like silver is just like this boring thing that it's just going to come at you like a thief in the night at some point. So I'm just looking at the January contract on silver. And so it's like we go down to the low 20s, but the highest that we got roughly a month ago, we got up to the 25 level. But silver's interesting in that it'll stay where you think it shouldn't for a while, but then it'll go where you think it shouldn't, but then it comes back to where you think it shouldn't. It never goes exactly where you want it. And so it's kind of one to where with what I do, I'm waiting for it to just wait out the boredom. And then all of a sudden one day we'll wake up and silver will be at 48 again. And at that stage, sell, wait for it to come back, and then repeat the process for another 8 or 9 years. And so that's kind of where I'm seeing silver at this stage.
Another 2-year collar we can all look forward to sinking our teeth into out there. Speaking of metals, interesting data we always recommend. We've had Eric Norland and Blue and the rest of the research team over there at CME on the show many times. Eric Norland was coming out with an interesting piece right before all this Fed stuff early in December. He just tracking the performance of gold amid various periods of rate hike expectations and rate decrease expectations and how it has performed or perhaps underperformed. And what he's found is a lot of interesting things. You can check out this report for yourself. It's entitled Gold Underperforms Amid Rate Hike Expectations. And again, the title kind of says a lot there, but as Eric usually does, it's a great piece full of great visuals and everything else, a lot of great charts. I encourage you to go check it out for yourselves over there at CME. Some of the takeaways, though, gold showing a consistent negative correlation with changes in expected Fed fund rates. Again, probably not a big surprise out there. Expectations for falling rates obviously boosted gold from around mid-2018 to middle of 2020. Since that level, though, since we saw that nice run-up in gold, the thought, the expectation, we haven't seen it in practice yet, but just the expectation that the Fed might start to tighten things, that seems to have been weighing on gold ever since. And at least as Eric has crunched the numbers, he views gold as a, quote, major underperformer among risky assets, despite surging inflation. That's kind of something we've noted as well. And we'll get into this probably a little more on next week's end of year show, breaking down the performance of all the major assets, maybe some surprises, the correlation, the shocks, the big movers and shakers, all that stuff that's coming up next week. We'll see where gold falls in that. But yeah, a lot of people who look to gold in this period have been a little bit surprised at their performance. and maybe some of that money flocking into crypto. That's been a popular play in the inflation era, and maybe some of that siphoning off the luster for gold. Not sure really why this has underperformed as aggressively as it has, but the numbers don't lie, and gold has underperformed. Let's look really quickly since we're talking about gold. Uncle Mike just talked about silver. Not a lot blowing the doors off in silver this week. Gold doing a little bit more action, a little bit more paper as well. 75,000 contracts on the tape for the shiny stuff right now. If you're wondering, gold at about an 1810 coming into today's show, up about 5 handles or about a little over about 1/3% on the week. And in terms of where the action is, unlike an equity, the gold paper goes out a little bit. Goes out to about a month to the Feb contract. We have about 33, almost 34 days left to go. That's where 31.5% of the paper went up this week. That's also where we're going to hang our hat this week. The gold vol, I've been talking about this a lot on the crypto show if you haven't heard it. Crypto vol starting to perform a lot like gold vol and other precious metals vol, where it will hang out in a range for quite some time, then might have a nice sharp move, but it's very short-lived and it comes right back to that range again. We're seeing that in gold. Gold hanging out at about 12.55 right now, off about 1/3 of a point. So you're still talking roughly 3x the vol of the 10-year, but it's not an equity, nor is it a crypto or anything else like that. We're seeing much lower levels of vol. You're talking Bitcoin, you're talking a 70 to 80 vol. ETH, you're talking threatening triple digits. Not quite there on the gold front. In terms of skew, last week the puts about 0.75% rich. This week, about 0.2% actually cheap. So swinging nearly a full point in the other direction. The calls last week were where the action was, 2.8% rich. This week, catching a bid, 3 more points, 5.8% bid now were the calls over that fairly anemic 12.5 vols. I mean, you're not talking a ton of vol to begin with, so 6% premium or so isn't a ton. But still, it's showing where the interest is out here, and it's to the calls right now, which is what we typically see out there in the metals. And in terms of calls and where the action was this week, the most active contract in gold, which is interesting given that we're about an 1810 right now, and what Eric was just crunching the numbers for with underperformance. The 1900 calls were leading the dance with about 5,000 contracts on the tape. Almost all of that going up on Tuesday. About 3,300 going up on Tuesday. Slightly closing. The rest of the day is kind of light, so it's pretty much all on Tuesday. We also saw the 18 halves going up that day 1,200 times, so maybe a bit of a ratio. We do see some weird upside ratios going up in gold, even though this one doesn't seem to line up that well. Following the 1900s, let's see, that was really where most of the action was. Then you got to go back to the 17 half puts that are going out in about 5 days in January. Those did about 2,300 contracts. Kind of even throughout the week, about 700 contracts a day, except for Monday, where they only did about 21. So a little bit of back and forth. So not a ton of weird stuff. Let's go a little bit farther out. Sometimes in gold, we see these funky upsides, the 2400s were trading yet again, this time in June. So maybe some funky verticals. Let's see. The 2400s went up 1,030 times on Tuesday, and most of that was closing, followed by 532 of the 2100s. So a bit of a funky 1x2. Both of those were closing, though, so it looks like maybe someone taking off a bit of a funky 1x2. At the same time, also opening on the 27 half and 32 half strikes, 1 by 1. So maybe a 500-point vertical. They close the ratio and they open a 500-point vertical. 32 half by June of next year. That would be an impressive level for gold, but again, crazier things have happened. Speaking of crazy things, Mr. Uncle Mike, sir, where do you think we should hang our hat next?
So let's see. So we've already done the light side and the dark side.
Well, we've done metals and we've done rates, pretty much.
Well, I mean, we can go with either the. How about we go with the S&P?
Equities, it is, sir.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody. Let's head out into the equities landscape. Take that drop down, pop it out of metals, which is at the bottom of the asset class category. You're going to go up about 3 slots to equity indices. Then you're going to head on over to the U.S. index. And Uncle Mike likes a little S&P, so we can hang out there. We also got the Russell 2000 in our movers and shakers this week, so probably have to hang out there. Before we get into all that, let's look really quickly. Let's set the table from a vol perspective. Coming into showtime, we had the RVX, which is, of course, the VIX of the Russell 2000, at about a 26.5. That puts it down almost 6.5 points from this time last week. Obviously, we were hanging out well into the 30s this time last week, but of course, a little bit different vol regime on the board this time last week. VIX coming into showtime was at about exactly an 18. That puts it down about 2.5 handles from this time last week. A VVIX, which is, of course, the vol of vol, at about a 121, down, about 7 points or so from this time last week. And vol Q, which is the at-the-money vol of the NASDAQ 100, also one of the newer tradable vol products over there at CME. It was at about an 18 exactly kicking off the show. It puts it down about 5.5 points. I mentioned on one of our other shows earlier today, this is one of the larger drawdowns we've seen in vol Q since we've really been watching it. You know, quite a big drop off in NASDAQ vol over the past week or so. That puts that VIX to RVX spread at about 8.5 points. That's actually coming in. It was even wider, if you can believe it or not, this time last week. So the small cap to large cap vol spread was over 12 points last week, about 12.5. It's come in nearly 4 points from this time last week. And the VIX to vol Q spread, believe it or not, when we kicked off the show, both of them were printing exactly 1801. So that means that VIX to vol Q spread, so the NASDAQ to S&P 500 vol spread, was literally zero. I don't think I've ever seen that before. I need to get Scott Nations on, who's the creator of VolQ. Ask him what he thinks about a zero. I know he watches that spread diligently. What he thinks about a zero, no premium at all, NASDAQ over S&P. That's intriguing. Mr. Uncle Mike, what do you make of that? And what else is lighting up your tape in the world of equities these days, sir?
Yeah, zero seems like kind of a surprising number. That's something I wouldn't have predicted.
I can't recall seeing that before, sir.
Yeah, that's something else. But with that, just looking at the S&P Mini, I mean, we have a shot at we're about an hour before the close of the cash trading today. If we get a decent rally in the S&P Mini, we could actually have new all-time highs in it on the close. But we'll see what happens. There's still a lot more trading to be done. But yeah, right now in the equity space, we are near all-time highs. And so whenever we have that, we just have to be cautious of double tops or things coming down. With the VIX coming down like it has, we've dropped almost a third of the VIX value between Monday and today. So there's definitely a lot less fear in the market in terms of VIX. And what's going to be interesting this next week is that typically there's really not a lot of movement in the markets, but we had the crazy move on the day after Thanksgiving this year, which that almost never happens. And so with lower volume, we might get a lot of movement going into the end of the year. Now, the only other thing that I could see happening is that we could sell off a little bit because of the fact that we've had such a rally this year that fund managers may want to take some money off the table and kind of sandbag, because if they've already had a great year, what's the point of working to get more money this last week when a lot of times the way with which they're paid is based on the annual return? And so why risk 51 good weeks for a 52nd good week when in reality it could only screw you up? And if the upside of making a lot of money the last week isn't going to be as great as the potential downside of taking a great year and making it into a bad year. So I wouldn't be surprised if we did get a little bit more selling next week than what we typically do at the end of a lot of years. And like I said, the reason is that I think fund managers might be sandbagging a little bit. The other thing with the equities right now is that there's a lot of sector rotation going on. If you look at Amazon, for example, Amazon has really not had a lot of movement in terms of from start to finish between the beginning of the year and right now. So just looking at a chart of Amazon, I know this is a futures show, but we really, if you go at least as of 3 days ago, we're really not that much higher than where we were at the beginning of the year with Amazon. And Amazon, of course, in 2020 was one of the darlings of the stock market, but now it seems like it's a little bit boring. Now, the market itself has had a lot of movement this year, but it's just come from different places than it did during the COVID era boom of a year ago. So I think right now the thing to watch in 2022, as well as perhaps a little bit next week, would be just where is the rotation going to continue to go within the market itself. Ultimately, at least as of the last couple of years, all roads lead higher, but there might be some roads that go lower than others.
Uh-oh. That's not speaking like a permabull, sir. So let's go on out to the S&P. Let's see for ourselves. E-mini S&P, another active week, 1.6 million contracts on the tape for the E-mini. We were talking about it on our Options Bootcamp show, how everything small is big again, and who would have thought we'd see a year where small is so big that the CME would just delist the big S&P futures and options. We don't need those anymore. It's all about the E-mini. In fact, the E-mini isn't even big enough, isn't even small enough, I should say, anymore. Micros are all the rage out there. But let's see what's lighting it up out here. As is the case with most equities, 25, almost 26% of the paper going up in the end of year contract that has about 8 days to go. So we're going to roll a little bit farther past that. We're going to go down to the week 3 Jan contract that has about 29 days to go and also did 16% of the paper. So a pretty active contract out there this week. By the way, S&P about 47, 27.5 as we're kicking off the show, up about 2.5% since Monday's session. The vol out here in this Jan contract at about a 13.1. It's off a whopping 4.6 handles just since the beginning of the week. So I mentioned at the top of the show, or at the top of the segment, vol cratering this week, listeners. Again, and looking at these skews, this is why we're saying it gets interesting when you're looking to hedge and do things out here, because the puts last week were 24.8% rich. Now, you got that 13 vol that isn't that high. That's one of the reasons why these numbers can get so astronomical. But still, you're talking about a 25% premium if you want to go buy a 25 delta put right now. And it gets even higher this week, nearly 27%. So puts getting more bid. Calls last week, 15.3% cheap. This week, 21% cheap. So I guess the good news in there is calls are cheaper if you are so inclined. But intriguing stuff nonetheless out here. In terms of where the action was this week, the most active contracts were the 3840 puts going out in about 4 days. They have 20,000 pretty much exactly. Actually, we have the 3965 puts doing 34,000. That makes a little bit more sense. 34,000 sounds like a more of a number one spot, followed by the 4100 puts doing 30,000 contracts, and then the 3975s doing 22,000. Before we get to the 3840s doing 20,000 there. So that makes a little bit more sense. And looks like my data was a little slow to update there. So intriguing stuff out here in the E-mini. But before we head out of equities, I did mention we actually have the Russell 2000 actually breaking into our movers and shakers this week at number 4, up nearly 4% on the week. I know a lot of you have been pretty active and watching all things small caps out there, doing pretty active paper this week as well. About 25,000 contracts on the tape coming into showtime. Let's look really quickly here. The most active contract out here, actually, again, the week 3 Jan contract, 29 days to go. That's interesting how that contract, that duration is getting a lot of interest in the equities right now. Let's see, we're at about a 2240 exactly right now in the Russell 2000. And let's see, the vol out there at about a 22.25 in that Jan contract. It's off 5 points this week. Put-wise, I should say skew-wise, last week, actually, not a lot of evolution in the skew. Last week, the puts were 17.2% bid. This week, 17.3%, so pretty much unched. The calls last week, 11.6% cheap. This week, 12.3% cheap. So calls a little bit cheaper. Just since Monday, the Russell 2000 up 3.3%. So obviously, if you go back to last week's show, it's up nearly 4%. And in terms of the most active contract, looks like it was the 18.5 puts. So again, we're at about a 2240 right now, and it's 18.5 puts leading the dance out here this week. Looks like they were pretty active all week long and mostly closing. So it looks like someone maybe getting the heck out of Dodge on the 18.5 puts here in the week 3 Jan contract. I don't see any reopening, so it's not like they're rolling. In the past, we've seen some out of the money put rolls in the Russell 2000. Not this week, just straight up closing on the 18.5 puts, perhaps deciding that was a bit of a bridge too far. And I can hear you folks out there. You're saying, hey, man, what about the ags? There's a ton of ags on the tape this week. So I hear you. We got to head out to the ags next.
It's time to get our hands dirty exploring the latest options, trades, and trends in corn, wheat, soybeans, and more. It's time to talk ags.
All right, out there, listeners, it's time to explore the world of ags. It starts with A, so it's easy to find on that asset class list. Go to the top of the list, which gets you to ags, of course. Then we're going to head out there to the grains and oil seeds. We're going to go to Chicago wheat first, because that was number 3 on our movers and shakers. We can go to KC wheat, it's number 2, but the Chicago wheat does more paper. So let's head out there first. By the way, if you're wondering how much paper is going up in the old SRW wheat, about 47,000 contracts on the tape right now. And of that, looks like almost half, 47.5% going up in this Feb contract that has about 29 days to go. If you're wondering where the heck is SRW wheat right now, it's about 815 and a quarter, up 40 and a quarter points, or about 5.2% just this week. So most of that move coming since Monday here on the old SRW wheat. And of that action, let's see, vol wise, what is the vol in wheat right now? It's actually 26. So pretty juicy, 26 and a third, actually unched. So the vol hasn't really changed this week. Interesting. So you're getting a little bit more juice in the ags right now than you're getting in your traditional equities. All of you out there who in the past have been saying, where can I go to find a little bit more vol if you don't want to hang out in crypto or some of these other ones? And obviously not a lot of vol to be found in precious metals right now. Perhaps the ags could be an interesting stopping point if you are intrigued by these markets and want to spend some time learning about all things ags. In terms of skew out here this week, we got not a big change. Last week, the puts 4.6% cheap. This week, 4.3%. The calls last week, 5.6% rich. This week, 3.3% rich. So a little bit of a decrease in the skew on the call front, puts kind of unched. And in terms of where the action was, let's get out to it's the 8-10 calls actually in March. So these are pretty much in the money calls right now. Actually, I take it back. 750 puts, 7.5 puts. We're doing the lion's share of the paper this week, doing about 2,300 contracts. Let's see, the big day was Tuesday, about 1,100. The rest of the week was pretty much even around 500 or so. And looks like mostly closing on Tuesday, slightly opening the rest of the week. After the 7.5 puts, we've got, looks like that's where the 8-10 calls come in at number 2 with about 1,600 on the tape. Let's see, the busiest days were Tuesday and Wednesday, about 600 on Tuesday, 660 on Wednesday. Looks like they were opening and closing both days, opening on Tuesday, closing on Wednesday. Maybe a little bit of a midweek trade, and then only a few hundred going up today here. Interesting stuff. We don't get a chance to hang out in wheat that often. Let's go check really quickly, since we're hanging out in the grains and oil seeds. Anyway, let's go to that same drop down, listeners. Let's go a couple of notches above it to our number one light side mover this week, which is soybean meal. So not soybeans, not soybean oil, but soybean meal, which actually does decent paper, about 60,000 contracts on the tape right now, listeners. If you're wondering, soybean meal at about a 401.90, so almost 402 out there right now, up 6.75% just this week. You go back to last week's show, you're up nearly 9%, 8.9%. So a nice little pop here for soybean meal. And because they like us, because it's not an equity, they did almost 2/3 of their paper, 64%, in the March contract that goes out in about 57 days. So we can easily hang our hat out there. Let's see, the vol in soybean meal also about a 25, so mid-20s for both the wheat and the soybean meal, which is kind of interesting. It's up about 0.5 point this week. So again, a little bit more juice in the ags these days, which may make it more intriguing for some of you out there. In terms of skew, a bit of an evolution this week. Last week, the puts were 1.4% rich. This week, 6.5% cheap. So a big swing on the puts. The calls also moving quite a bit. Last week, the calls 3.7% rich. This week, 10.5%. So that's quite a bid coming in on the call front. Let's see what was trading out here. Perhaps we can intuit a little bit. It looks like the par calls, the 400 calls, which are now the in the money strike, that was leading the dance all week long, doing nearly 5,000 contracts. The big day actually today, about 2,100. Yesterday, 1,400. Tuesday, about 1,000. Only a couple of hundred on Monday. Closing the rest of the week, we don't know what's happening out there today, but maybe there were some shorts, people getting a little bit spooked on that 400 strike, so they were buying them back all week as we got closer and closer. That would explain certainly why these calls got very bid from a skew perspective out here. Intriguing stuff. Followed right behind it by the 370 puts, about 4,200 of those going up this week. The big day for those, actually Monday, 2,300 going up, all of that opening, followed by, looks like about 500, 600 every other day of the week, and all opening all week long. So opening on the 370 put side, closing on the 400 call side, and maybe some folks legging into risk reversal, selling out those puts because the put wing got crushed and the calls got bid up here in all things soybean meal. And, I talked about it before. I said it's one of my surprises of the year. Let's do a real quick stop since we're hanging out in the ags anyway. If you go one notch below, listeners, you can see livestock there. And number 5 on our list this week for the movers, shakers to the upside is lean hogs. So let's head out there because that product's doing some paper these days. It's beating the pants off silver. Silver only does 18,000 contracts this week. Lean hogs, 38,000. So this is definitely a place where we can start hanging our hat from an options volume perspective. I know most of you don't follow lean hogs, so I'll just tell you, it's at about an 83.3 right now, up about a little over 3% on the week. You go back to last week's show, it's up nearly 4%. So a nice little move here for the lean hogs. And looks like Jan's already off the board. So Feb is where the action is right now. And that contract did 52, almost 53% of the paper of, again, a skyrocketing 38,000 contracts. That's a lot of paper for lean hogs. When we first started doing the show, listeners, lean hogs are kind of an afterthought. Now, I'm doing some numbers. In terms of vol, what is the vol in this crazy contract? It's at a 26. It's right in line with what we saw with soybean meal and with Chicago wheat in the mid-20s range. So again, livestock hanging out in that mid-20s level, ags really across the board hanging out in that level. So if that intrigues you, I'm not saying you should dive right into lean hogs, but maybe some of the more broad ags like corn could perhaps be a good starting point. But still, intriguing how all these vol levels are very similar out here right now. And in terms of skew, we have the puts last week, 14.1% bid. This week, 14.6% bid. Last week, the calls, 9% cheap. This week, the calls, 11.5% cheap. So calls coming in slightly, puts getting a little bit more bid as well. And in terms of the paper, let's see. The big dog this week are the 76 puts, 76 even puts. I said we're at about an 83.30 right now. The 76 puts were active all week long, about 2,300 total going up this week. The big day was Tuesday, 1,600 of them on Tuesday. Most of that opening, followed by a couple of hundred the rest of the week, of each day the rest of the week. Again, most of that opening throughout the week. So it looks like a lot of opening put activity on these 76 puts, maybe while those puts are getting ever so slightly more bid up. Again, there's not a ton of strikes out here, so some of the skew change you can read with a bit of a grain of salt, but still intriguing stuff. We also saw a lot of action if you go farther out all the way to Dees of the next year. We get the 74 puts doing about 1,200 contracts as well. So downside puts seem to be the order of the day out here in livestock. So there you go, a 3 for all you ag heads out there. But now it's time to get to some of you folks on the show. It's time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right. Welcome to the Futures Options Feedback. Mr. Uncle Mike, sir, I spared you from the ignominy of talking ags, but are you ready to answer some questions, sir?
Absolutely.
All right, let's see who we got. Let's go to Josh first. Why not? Josh wants to know, I've seen people recommending that if your position is losing money, you should buy something else so that your deltas are even. So if your delta is, let's say, minus 400, you go over one strike and sell enough of that the delta of your position is around plus 400. I don't get it. What does that do? Well, it's kind of hard to intuit what you're putting down here from your question, Josh. The way you word it is a little confusing. You say if you're minus 400, so you're short 400 deltas, and then you go over one strike. I'm not sure what you mean by that. Like, let's say you're short, I don't know, the 4,000 strike in the S&P, and then it blows through your strike to the upside. Are you going to go 4,005? Or are you talking about maybe going out, let's say, to the next cycle, maybe in the weeklies or maybe more likely in the monthlies. So going out a month and you may say sell more delta, but you want to get positives. So you want to buy more deltas. So you want to buy back, let's say, a positive 400 delta so your delta works out to even. I'm going to assume that's what you mean by your question here, Josh, that you're legging into a calendar. So, Mr. Uncle Mike, is that how you read this question as well? Maybe you have a different interpretation than I do. And if so, what are your thoughts on legging into a calendar to try to do a quasi delta neutral type of trading, sir?
Yeah, I think that's how I'm reading it as well. I guess it just depends on what you're trading. If you have that much positive delta in the first place, then you're probably bullish. And then if you're going to sell that much delta against it, what's changed that you're not that bullish anymore? So I think ultimately, if you're looking to just get out of the trade from a risk management perspective, I think it's simpler to just close out the position. But the second that you sell and leg into a spread, you've gone from being a bullish trader to a neutral trader that's trading time decay and volatility instead of movement of the underlying. So I'd prefer to just get out of the trade if it was going against you.
Yeah, I'd have to agree. If you're fixated on delta, you're very directionally focused. And now you're talking about, as Mike said, you're not just trading delta neutral, which we used to do on the trading floor all the time, but we would use underlying to do that because it has no other Greeks with it. It's just straight delta. If I want to get delta neutral, I'll go buy 400 deltas in the underlying, and that makes me delta neutral. But what you're talking about is legging into a spread. So now you might be delta flat, but you have a whole other residual position that you've now put on. In your case, you're legging into a calendar. So in that case, if you're going to be long the calendar, again, it kind of depends how you put it on. But if you're buying farther out stuff, you're probably going to be long a traditional calendar. So you're long, let's say in our example, 1 month out, and you're short and near dated. So now you're short gamma, you're long vega. You have all these other things going on that you may or may not understand very well. So yeah, if that's your case, if that's your direction or delta is your fixation, you're maybe doing a little bit of near-term swing trading. You don't want to add to the complexity of your position just to get flat deltas. Just take the deltas off and live to fight another day. Again, I'm not a fan of, mixing these two things together. If you want to get your deltas flat, then use a product that is just delta. Don't add the ancillary things. If you start legging into spreads, you have to know what you're putting on as opposed to what you're just taking off. All right, let's go. We got time. Let's do one more here. Kind of a straightforward one, but maybe seemingly not. This comes from Jay Jonah. A lot of J names on the show today. Jay Jonah says, can you please explain the month codes used in futures options for your listeners? I find them confusing. Thanks and love the show. Well, I'm with you on those, Mr. J. Jonah. They are confusing. They are extremely confusing. And there is no answer as to the rhyme or reason as to how and why they exist this way. I have put that question to many different people. Why do we use these this way? And the answer is always, that's kind of just the way they are. So luckily for you, Jay, Jonah, and everyone else, if you are confused by these, you can find them very easily for yourself. Just type CME contract month codes into your browser, and it'll take you right to this page that has them and nothing else on it. It's a very straightforward page. It'll show you the exact codes, starting with Jan, which is F, going all the way through December, which is Z, and has everything else broken out in between. If you're confused by these, maybe you bookmark this page, or maybe even just print it out and cut out that little section that has the thing, and you paste it somewhere next to your trading screen so you could look at this, because it doesn't make a lot of intuitive sense. You might say, oh, D is Z. That makes some intuitive sense. And you say, yeah, but then November is X. So you're skipping right over Y. The year doesn't start with A. It starts with F, and it goes to G. It's not intuitive really at all. So I wish there was some helpful tip I could tell you, well, this is exactly why every month is the way this is. The answer is there really isn't a rhyme or reason to that. That's just the way it is. I'm with you. It sucks. It's an impediment for new traders to learn these products, but it's kind of the way it is. And so that's why I encourage everyone, just type in CME contract month codes. Maybe your broker does a good job of also explaining this content, but probably not. So just go straight to CME. They have it right there. Pull it up when you're trading, and it'll at least help you understand what the heck it is you're trading, which is obviously the first start of any trade. Mr. Uncle Mike, you have any words of wisdom you could pass on to Jay Jonah, who's confused about contract month codes in futures, sir?
Yeah, I have a broker that just updates the futures themselves for me automatically. So I cheat. I don't know them either, but I understand the concept, which is what's important. And but in terms of the month codes, I'm not sure where they came from.
Yeah, I think most modern platforms will try to translate these for you, which I think is the better way to go than trying to say, make sure you remember that N is July. A lot of people are not going to. It's like when you look at your Apple options, whatever else you're trading, you don't know the exact symbology of it. Your broker translates a lot of that for you, so you don't have to know that. And you still need to know what the overall order is, but outside of that, you don't need to know July is N off the top of your head if you want to go trade out there. But you should be at least cognizant of these things. Good questions out there. Who do we have? We had Josh and maybe J. Jonah Jameson, maybe from Spider-Man fame. Maybe he's riding in this week. All right, listeners, that music means we've come to the end. Man, an hour flies by when you're talking futures options with the Uncleist of Mikes. But Uncle Mike, before we go, if folks have questions, maybe outside of the contract month codes, they want to hit you up about, maybe they want to talk silver or 10-year note, where should they go? What should they do?
Well, I'm a financial advisor who works with the option product, assuming it's appropriate for the client. Feel free to follow me on Twitter at Mike TOSAW, TOSAW, or check out my website, stcharleswealth.com.
And you already know to go to find all these great reports, cmegroup.com/TWIFO or /TWIO. While you're there, check out some of that great research from Blue and Eric and the rest of the team there. It's great stuff, and it's all free. So you can't beat the price, and it's good data. It'll make you think about the way some of these products interact, which is always interesting. And, of course, you know where to go to learn more about small caps, which are blowing the doors off again this week. Is it Santa Claus rally time again? Is it not? Was it correction? Was it not? What is the impact of COVID-19 on all this small cap madness and a whole bunch more? FTSERussell.com, FTSE Russell.com is the place to go to begin your small cap journey. Give them a follow on the old Twitter as well, at FTSE Russell, all one word. We got to get the heck out of here. That's going to do it, like I said, for our broadcast week this week. Thanks for joining us. Everybody out there, have a great and happy holiday. No matter what the heck it is you celebrate, just have some fun at the end of this week. Turn off your screens, enjoy, relax, see friends, see family. Maybe see them remotely if you have to, but still engage with them a little bit. And then we're back again on Monday with the option block all the way through till next Thursday. Another episode of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit FTSERussell.com, CBOE.com, and CMEGroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores.
Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.